Even if you only have about $500 to invest into the stock market, you can start building a very good diversified portfolio. Today, I'm going to show you how to build a very good diversified portfolio with as little as just $500. Let's get started. What's going on, you guys? Welcome back to my channel. This is Alice, and welcome back to Money with Alice, where we talk about all things personal finance, investing, and so much more. If you haven't already, make sure to give this video a like and also hit that subscribe so you don't miss out on future videos. I share a lot of really good tips about finance, about investing, and just really fun videos to watch. Alrighty, so on to today's main topic, how to build a portfolio with $500. So I hear a lot of people ask, if I don't have a lot of money, like if I don't have like hundreds of thousands or millions of dollars, is it even possible for me to invest in the market? And the answer is yes. It doesn't require having a boatload of money to start investing in the market. So today, I'm going to share with you a very simple strategy for building a very beginner and super easy to maintain investment portfolio. So let me just give a little bit of a spiel about why I think everyone should be investing in the market. So why invest at all, right? Why not just put your money in the savings accounts? Well, savings accounts nowadays, interest rates are super low. And when the interest rate that is dictated by the government is super low, what that means is the money you're putting into your savings account is getting a really bad return. In the past, maybe you could be getting like a 2 to 3% on your savings every single year, but now that thing is as low as like 0.5%. So if you're putting $100 into your savings account every single year and that's generating like a 0.5% return every single year, what does that mean? That means you're only getting 50 cents for every $100 you're putting into your savings account. So you might ask then, if my returns on my savings account is so poor, like 0.5%, I'm barely getting any money for it, is there maybe another alternative way that I could be putting this money towards? Something that generates higher than a 0.5 return? And the answer is yes. You can put your money into the equity markets, into the stock market, and that on average has returned around 9% every single year. So if you put $100 in yesterday and you grow it for a year, that money a year from now could get you to become $110. Now comparing that $10 gain to that 50-cent gain in your savings account, not too bad of a trade-off, am I right? Now, the easiest way to start investing is to start doing it today. There's never been a moment that's too late to start investing in the market. If you're a new investor and in the past you've never put any money into the stock market, think about putting that money starting today. Because the second you put that money into the investment accounts, it's going to start growing. Your money's going to start doing the work for you so that in the future, when you retire or when you have a lot of cash needs, you'll have a good chunk of change and more for you to spend. So the summary of the spiel is, put your money into the market today. There's never been a better moment. It's never too late, and just do it. Well, don't just do it, but I'll share with you some tips and guidelines on how to actually put your money to work into the investments. Now, for the beginning investors, this is the absolute beginners who've never looked at the stock market, never really looked at stocks, and you don't have a trading account. The first thing you need to do is to open an investment account. Opening an investment account is pretty easy. It's just like how you usually open like a checkings account or like a savings account. There's a couple of different brokerage accounts or brokerage platforms that I recommend. The key thing to watch out for is the offerings that this investment platform gives you. How good is the research platform and how good is the customer service? Some platforms that I personally really enjoy using is like TD Ameritrade, Charles Schwab. Robinhood could also be a popular one, but I think it really depends on overall what sort of experience you're looking for with the platform. Some of them have mobile offerings, some of them have an internet offering, some of them have another trading platform you can use to do your research. So do a little bit of research before committing to a certain platform. But overall, you're not really at a lot of disadvantage if you open a Robinhood against a TD Ameritrade. The key thing is opening a brokerage account will allow you to start trading stocks. And that is accessible through any of the platforms. Doesn't matter whether you have a Robinhood, Ameritrade, Schwab, Fidelity, etc., etc. You can still access the same tickers to buy and sell. And that is the key focus for how to start building an investment account. All right, so once you have your investment account set up, everything's ready to go. This is the fun part. trying to figure out, what do you put your money in? What do you spend your money on? So for today's focus, it's on how to build an investment account with only $500. For a beginner investor, or for someone who's investing a relatively smaller sum of money, like $500, the key thing to focus on is a concept called diversification. Now, what is diversification? Diversification means that using your $500, you're able to invest in a lot of different stocks or a lot of different exposure into different companies. Now, why do you want diversification? Well, if you have diversification, if you're investing in like 10 different things rather than one thing, if one of the 10 things goes down and goes into bankruptcy or really goes down the drain, you hopefully have that 9 other investment that is helping you to offset that one loss. Whereas if you put all your eggs in one basket, if that thing goes down, your entire portfolio is kind of screwed. So that's why with anyone who is starting to build a portfolio, and especially if you're starting a portfolio with $500, diversification is the key concept that I really recommend making sure that your portfolio has. The other criteria I would recommend when you're starting to build just a beginner portfolio from scratch with only $500 is to look for blue chip investments. Now, what are blue chip investments? Blue chip investments means these are the companies that have been around for a really long time. They're pretty large, and chances are they're not going to disappear in like 10 or 20 years. What that means is that if you put your money in today, in 10 years and 20 years, you're not going to see that stock go to zero, and your money will still be there and then some. So they're relatively safe. The downside with putting your money into a blue chip stock is that there is a little bit of a slower growth compared to something that's more high risk. You might have heard the term called high risk, high reward, or risk-reward trade-off. This is something we can cover later, but for a beginner, what I really recommend is looking at blue chip companies to start building a stable portfolio, because those are the ones that are most safe, that will generate a really good foundation. So as you start getting more than $500 and you're able to build up a portfolio, you can add on top of that. So think of the $500 of blue chip stock sort of as a foundation for your house, right? In order to build a house, you have to start with a really good cement foundation. And that is what blue chip stocks will offer. It'll offer you a really good foundation to start building more diversified and more complex strategies in your portfolio. Okay, so guideline-wise, 2 main factors for anyone that is looking to start investing today or start building a portfolio with $500. One is diversification. Be able to have a couple different areas of stocks that you invest in, or a couple different strategies, so that if one goes down the drain, the other ones can hopefully offset that. 2 is to look at blue chip stocks and start building a good foundation, so that as you're adding more and your investment portfolio becomes more complex, it becomes larger and greater than $500, you're adding on top of a really stable foundation. Okay, so I'm going to go back to the topic of diversification a little bit. So if you only have $500, which is today's topic for the video, chances are, because stock prices for these really large blue chip companies, since they've been growing for like 20, 30, 50 plus years, the price might be a little bit expensive. So if you're trying to build 20 different companies with only $500, it might be a little bit difficult, because chances are these investments, maybe even one stock costs you $500 alone. So in this scenario, what's the best course of action? That's where the concept of exchange-traded funds come in. Exchange-traded funds are, in a very short summary, they're a basket of a lot of different stocks that have been bundled by a certain company, and then that company offers it almost like another stock that you can actually buy. The good thing with an exchange-traded fund is that you're technically only buying one stock. It's similar to just if you buy and sell one stock. But when you buy and sell that one stock, you're actually getting exposure to a bunch of underlying different stocks that the other company has already bundled on your behalf. So that's why for anyone who is just starting with a small amount of money, like $500, looking to invest in a diversified and safe portfolio, I recommend looking at a exchange-traded fund as the foundation and the base layer to start building your portfolio from. Now, ETFs, or exchange-traded funds, has a lot of different types that you can buy. In fact, in the US alone, there are over 2,000 ETFs to pick from. So with 2,000 plus options, how do you determine which one is right for you? And how do you even determine what the basket is supposed to be? So within ETFs, within exchange traded funds, there is a most common category that is called index funds. Now, what index funds mean is that their investment holding mimics the holdings of a certain index that has been created to sort of create a benchmark to measure how the market is performing. So some of the common ones you may hear is like the Dow Jones Index, the S&P 500 Index, the NASDAQ. So these three are the main key US indexes. And these indexes sometimes signify different things because they compose of different baskets of stocks. So the Dow Jones, for example, those contain the 30 largest companies in the US. So they generally, you can think of them as the companies that are the most stable, and this sort of tracks how the US market is doing for the most stable investments. Whereas the S&P 500, this contains a basket of 500 different investments. For the NASDAQ generally you can think of as more of the technology type investments. A lot of the companies that are in the NASDAQ basket tend to be more technology heavy. So a lot of investors like to use the NASDAQ as a proxy for how the tech basket or the basket of technology companies in the US are performing. So again, index funds is a category of exchange traded funds. And what they do is they construct a basket of stocks that mimic the intended basket of index they're trying to match. S&P 500 index, for example, will contain 500 different positions with the 500 different companies that is tracked by the S&P 500 index. So in the index fund, there's a specific index fund that I think would be the best to purchase for anyone who's starting out with a $500 or a little bit of money to invest into the market. And that, what I recommend, is the S&P 500 index fund. With buying the S&P 500 index fund, if you only have $500, you can probably afford a couple different shares of the S&P 500 index fund. But just by buying one share in the S&P 500 index fund, you're getting exposure in your portfolio of 500 different companies. So that diversification is really there. In addition, you also fulfill your blue chip stock requirement because the S&P 500 tracks the 500 largest companies in the US. Generally, the larger the company, the more stable the company is, and the higher the likelihood that in 20-30 years, this company will still be in operation and it won't have gone bankrupt. So the S&P 500 index fund is offered by a couple of different companies. So you have a couple of different tickers to choose from. So like I mentioned in the earlier part of this video, these basket index funds are created by a certain company, right? So who are these people that make them? Well, the people that make them are usually the investment brokers. So like Fidelity has their own offering, Charles Schwab has their own offering, and they all offer a S&P 500 index fund. Now, how do you compare and choose which one is the right one to buy? There's a couple of different criteria that I would look at, but two main ones I really urge you to evaluate. The first one being the long-term average returns. Now, interestingly, even if you have two S&P 500 index funds, one could be offered by Charles Schwab and one is offered by Vanguard, their returns in the long run might differ a little bit. In the average, and for the most part, is ballpark similar, but there could be like a 0.1 or 0.2% difference. So look at the difference in the year-over-year returns and the long-term average of returns that these index funds have created and see if this is the one that you really want to invest in, because chances are the past performance gives you a really good indication of what you expect going forward for the future results. Although there is a famous investment saying that past performance should not be indicative of future results. But when none of us can predict the future, the past is the best proxy for the future. Now, the second criteria when it comes to evaluating any exchange traded fund or index fund or ETFs is the concept of fees. Now, all of these companies create this nice basket for you to invest in, so you can just buy one ticker and you get the diversified exposure, right? But there's someone on the other side of that company that's actually maintaining this portfolio for you. In order to make sure they're able to feed themselves and pay them a salary, there is a concept of fees. Generally, the fees are charged on a percentage of the invested capital, or the amount of money that you have put in to this index fund. For example, if you have a fund that is charging a 0.03% annual management fee on $100, do the math, and that means that it's $100 that you're putting into the market times 0.03. So that means you're paying them about 3 cents every single year in order to get the benefit of the diversification. So when it comes to picking the right index fund, 2 criteria you should definitely evaluate. 1, the investment performance in the past. How has it done in the last 5 years, 10 years, or since the inception of this concept? Is that a return that you're comfortable with? Second criteria is, how much management fee are you expected to pay every single year for the money that you're putting with them? Is this diversification worth the cost that you're putting with them? Generally, for the S&P 500 index funds, fees are usually pretty low. They're like 0.02% every single year or 0.03% every single year. But there is a little bit of a difference. So when you're picking between Vanguard or Fidelity, even on S&P 500 index funds, there might be a little bit of difference between the fees that is getting charged every single year. Now, for me personally, I really enjoy having the S&P 500 index fund offered by Vanguard, and that ticker is VOO. There, of course, are other offerings that the other companies also have that is for the S&P 500 index fund, so that could be something that you prefer as well. For example, I think Fidelity also has one. The ticker for the Fidelity one is SWPPX. Now, both the Vanguard and the Fidelity one have pretty low fees. Fidelity's is about 0.02% annual management fee, and Vanguard's is about 0.03% annual management fee. The difference between the two is not really large. It's a 1 cent difference if you're putting in $100. Now, both Fidelity and Vanguard are really good options for the S&P 500 index fund, so you really can't go wrong with either. So that is my 2 cents on how to build a portfolio with as little as $500. Don't forget, the best way to start investing is to start today, and it's never too late to start investing. For example, if you put $10,000 in today, and on average, the market grows at 9%, if you put that money into it today, and in 20 years you check your bank account, that thing is going to become $56,000. So it's a lot of money that you're missing out on if you're not putting that money into the market. I hope you guys enjoyed this video, and I hope you learned something about index funds, about investing. And if you enjoyed it, please, please, please make sure to like this video. If you have a friend that is trying to figure out how to do investing, make sure to show them my channel because I have a bunch of other good stuff. Don't forget to like and subscribe, and I'll talk to you guys really soon. Thanks so much for watching. Bye.